October 6th, 2025, Bitcoin hits an all-time high, $126,210. Twitter is exploding with rocket emojis. YouTube is flooded with predictions. 200,000 by New Year's. Newcomers are downloading Coinbase in droves, convinced they're jumping on a rocket ship to the moon. Today is February 10th, 2026. The rocket has crashed. Price, $69,000, down 44% in 4 months. Last week, Bitcoin plunged below 61,000 for the first time since November 2024. In a single week, $2 billion in positions liquidated. The Fear and Greed Index, 14 out of 100. Extreme fear. Most of the people who bought at the top have already sold, at a loss, in despair, convinced that crypto winter is back. Now, pay attention. Yesterday, February 9th, analysts at Bernstein, a firm managing $779 billion in assets, published a client note. The headline: "We are witnessing the weakest bear case in Bitcoin's history." Their year-end target? 150,000. That's more than double the current price. Same says Standard Chartered. JPMorgan's model puts Bitcoin at 170 on a 12-month horizon, and their long-term target, 266. Three of the biggest names in global finance, three different models, one conclusion. The current price is not the end. It's a pause. So who's right? Panicking Twitter or the cold spreadsheets of Wall Street? Welcome to the Crypto Vault. Today, we're breaking this down to the bone. To understand why Bitcoin is behaving this way, forget the crypto charts. Look at Washington. On January 30th, 2026, Donald Trump did what the market had been waiting months for. He named the next chair of the Federal Reserve, Kevin Warsh, former member of the Fed's Board of Governors, a man Wall Street knows as a hawk, a supporter of tight monetary policy. For those of you who don't follow macroeconomics, let me put it simply. When the Fed chair is a hawk, he keeps interest rates high. Money becomes expensive. Loans cost more. And the first thing investors dump in that environment, risky assets. Bitcoin is at the front of the line. The market reacted instantly. On January 29th alone, one day before the official announcement, $818 million flowed out of spot Bitcoin ETFs, the largest single-day outflow since November. For all of January, minus $1.6 billion. And if you count from November, when the reversal began, more than $6 billion have left ETFs. $6 billion. Sounds like a death sentence? Hold on. Here's a fact that almost nobody is talking about. Bitcoin's price dropped 44% since October, but ETF holdings shrank by just 6.6%. Bloomberg analyst Eric Balchunas compared this to the gold ETF GLD. During a 40% drop, GLD lost a third of its assets, and then it attracted $30 billion in new money. Bitcoin ETFs lost less than 7%. The vast majority of institutional holders are holding. And here's something else interesting about Kevin Warsh. Yes, he's historically a hawk, but in recent months, his rhetoric has shifted. Analysts at Invesco wrote plainly, "We don't think he would prove as hawkish as markets seem to expect." Warsh is now arguing that artificial intelligence is boosting economic productivity, which means rates can come down without inflationary risk. A paradox? Maybe. But markets run on paradoxes, and the ones who can read them profit. Let's put the cards on the table. 3 sources, 3 models, hard numbers. Number 1, Standard Chartered. Geoff Kendrick, Global Head of Digital Assets Research. A year ago, he was calling for 300,000 by end of 2026. In December, he cut his forecast exactly in half, to 150. In January, he reaffirmed it. What happened? Kendrick explains, one of the 2 engines of growth stalled. Companies that were buying Bitcoin for corporate treasuries, like Michael Saylor's strategy, can no longer buy as aggressively. Their market valuations won't support it. But the second engine, ETFs, is still running. Slower than anyone would like, but running. Investment committees at pension funds and endowments don't make decisions in a week. They move in quarters. Kendrick described the current environment with a beautiful phrase. Not a crypto winter, just a cold breeze. His 2030 target, 500,000, still intact. Number 2, Bernstein. And this is where it gets really interesting. Their note came out yesterday, literally yesterday, February 9th. Analysts led by Gautam Chugani didn't just reaffirm their 150 target, they went on the offensive. Quote, "Nothing blew up, no skeletons will unravel." Their argument, unlike previous crypto winters, the FTX collapse, the Terra implosion, there is no systemic crisis right now. There's a pro-Bitcoin president, functioning ETFs, major companies holding Bitcoin on their balance sheets. Bernstein believes this isn't a bear market. It's a crisis of confidence out of habit. Retail investors are panicking because they're used to panicking, but the market structure is stronger than ever. Their long-term target, $1 million by 2033. Number 3, JPMorgan. Nikolaos Panigirtzoglou, Managing Director. His approach is the most unusual. He doesn't set a target in the traditional sense. He uses a model that compares Bitcoin to gold through the lens of volatility. What does that mean? If Bitcoin stabilizes at gold's volatility level, and the data suggests this is already happening, its fair price should rise to match the volume of private investment in gold. That's roughly $8 trillion. Translated to the price of a single Bitcoin, $266,000. JPMorgan itself says this is unrealistic for 2026. But on a 6 to 12 month horizon, their model points to roughly 170. Now do the math. The most conservative of these forecasts, 150. That's more than double the current 69,000. The most aggressive, nearly 4 times. Does that mean you should rush out and buy? No. It means you need to stop making decisions based on panic headlines and start looking at the data. One important caveat. These same analysts have been wrong before. Standard Chartered called for 200,000 by the end of 2025. Bitcoin closed the year well below that. Forecasts are a map, not the territory. But when 3 different maps point in the same direction, it's worth paying attention. Now, the topic that gives newcomers chills: taxes. In 2026, a quiet revolution happened in the United States. It wasn't broadcast live, but it changes everything. It's called Form 1099-DA. The letters DA stand for digital assets. For the first time in history, the IRS has a tool built specifically for crypto. What does this mean in plain English? Coinbase, Kraken, Gemini, Robinhood, all of them are now required to report to the IRS exactly what you sold and for how much, exactly the way traditional stockbrokers have been doing for decades. Crypto is no longer in a gray zone, it's in the system. For the average person, that sounds scary. But flip the coin. Big money, insurance companies, university endowments, pension funds couldn't touch crypto for years. Their lawyers kept saying, too murky, too risky, no transparent reporting. Form 1099-DA removes that barrier. When the rules of the game are clear, players you've never even heard of start showing up. And there's something even bigger. In the US Senate, there's a bill called the Bitcoin Act. Author, Senator Cynthia Lummis of Wyoming. The idea? Create a strategic Bitcoin reserve at the federal level, purchasing up to 200,000 BTCs per year for 5 years. Total, 1 million Bitcoins. Let's be realistic. This bill faces a tough road. Lummis announced she's leaving the Senate in 2027. Kevin Warsh's confirmation has stalled. Senator Thom Tillis blocked proceedings. Democrats are demanding an investigation into Jerome Powell be completed first. But the sheer fact, think about this, the sheer fact that the United States Senate is seriously discussing buying Bitcoin for a national reserve tells you everything you need to know about where this industry is headed. Bitcoin in 2026 is not an underground asset. It's a line item on your tax return. It's a topic in congressional hearings. It's an instrument being analyzed by JPMorgan and Standard Chartered. Taxes aren't the end of freedom. They're a ticket into the big money game. All right, we've covered macroeconomics and forecasts. Now, the question that's keeping everyone up at night. Where's the bottom? On February 5th, the market gave us a clue. Bitcoin momentarily dropped to $60,062. It was fast, brutal, and painful. 2 billion in liquidations, panic in the chat rooms, headlines. Bitcoin crashes 15% in a single day. And then, a bounce. Back above 69,000. Classic move. The market shook out the weak hands and moved on. CoinShares analyst James Butterfill called 70,000 a key psychological level. If it doesn't hold, the next stop is the 60 to 65,000 range. That's exactly where, according to heat map data, the largest buy orders are stacked. But here's what really matters. JPMorgan estimates the production cost of one Bitcoin at roughly $87,000 to $90,000. We're currently trading below the cost of production. Historically, this has been a soft floor, a level where the price doesn't stay for long. When mining is unprofitable, miners shut down their machines, supply shrinks, and the system finds a new equilibrium. CryptoQuant adds a troubling detail. Bitcoin has broken below its 365-day moving average for the first time since March 2022. That's significant, but, and this is the crucial but, after every single break below this line in Bitcoin's history, the price didn't just recover, it went on to set new all-time highs. The only question was, how much patience did the investor have? A word of advice for beginners. Forget about the dream entry point. If you're waiting for exactly 60,000 to hit the buy button, you'll most likely be standing on the platform, watching the train leave at 62. The market doesn't hand out gifts on a schedule. Experienced investors do it differently. They use a strategy called laddering, setting a grid of buy orders at different levels, 70, 65, 60, 55. They don't know where the bottom is, but they know their average entry price will be better than someone who went all in on a single candle in a moment of emotion. That's what we at the Crypto Vault call the grown-up approach. So, February 10th, 2026, Bitcoin, 69,000. What do you do? The first thing to accept, the picture is not black and white. On one side, 3 of the world's largest financial research teams see a rise to 150 to 170. ETFs lost less than 7% of their holdings while the price dropped 44. That's extraordinary resilience. There's a bill in the Senate for a national Bitcoin reserve. On the other side, CryptoQuant data shows that institutional demand has materially reversed. The same ETFs that were buying 46,000 BTC a year ago are now net sellers. Bitcoin has broken below its 365-day average. Kevin Warsh, despite softening his tone, is still an unpredictable factor. Both sides are true, and anyone who tells you they know exactly what's coming is lying. We don't know. Nobody does. But we can act wisely. Here's a concrete plan. First, security. If your coins are sitting on an exchange, move them to a cold wallet. In the era of 1099 DA and heightened regulatory oversight, that's not paranoia, that's basic hygiene. Second, if you've decided to buy, use DCA, dollar cost averaging. Don't put everything on a single price. Split your amount into 4 or 5 parts. Buy once a week or once every 2 weeks. Let math work for you, not emotions. Third, watch the calendar. February 11th, CPI inflation data. February 18th, FOMC meeting minutes. Kevin Warsh's Senate confirmation hearings. Each of these events is a potential volatility trigger. Fourth, don't be in the panic camp or the euphoria camp. The fear index at 14, that's extreme. Historically, levels like this have often coincided with turning points. Often, but not always. Use it as one signal, not the only one. Bitcoin in 2026 is no longer an experiment. It's being debated in the Senate. It's being tracked by the IRS. It's being analyzed by JPMorgan, Standard Chartered, and Bernstein. The question is no longer, will Bitcoin survive? The question is, what will you do while everyone else is paralyzed by fear? Standard Chartered, Bernstein, and JPMorgan have already shown their cards. Now, it's your move. If you found this analysis useful, hit the like button. One click, but it helps YouTube's algorithm show this video to people who are making financial decisions right now based on panic, not data. Next video, top 3 mistakes beginners make in 2026. Mistakes that cost people their entire portfolio. Subscribe so you don't miss it. The Crypto Vault. We dig deeper than the headlines. See you next time.